Stock market analysis and projections, important information first. Please take time to read this slide. It talks about our approach to analysis and what it means to you to use the analysis that we share, and the important concept of trade ownership. You must own your own trades. You own your own trades, then you're going to be the one responsible for managing your own risk parameters, and that's what's key to your ultimate success. All right, we have a little bit of a market brief in here and lots of things that I'm going to talk to you about. Indexes thrashed wildly on tariff machinations this week. Wednesday saw historic upside reversal on a tariff pause, as the president paused for 90 days the tariffs he never put on anyway, which is really interesting. The S&P 500, NASDAQ, as of about noon, when I put these statistics in there, the Dow wasn't, and the S&P 500, the NASDAQ up 3 to 5% on the week. You would never really believe this feels like an up week, but the Russell's near unchanged, and it's really lagging because the small caps borrow the most money and interest rates are going up. So the Russell has been lagging. Investors are very on edge due to collapse in the dollar and bonds. I'm going to talk more about that in a moment. Intraday swings are enormous. This is great for trading or a huge challenge for trading. I've done, I think, a good job. When I do all the chart updates, I supply what I call my most notables. And then there is often teaching pieces around how to address certain market conditions. And I've talked about that a lot recently. Very, very important. So if you don't get that, levels 2, 3, 4, you all get to see my most notables when I post those, and really talking about how to engage in a market like this. Has the worst been seen for stocks for now? I think it's possible, and I'm going to show you why. What are the dynamics that are moving the markets in this incredible way, where you're having the bond market collapsing, the dollar collapsing, the pressure on stocks, and then releasing in a big way? All of those things are very important to understand how they're all working together, because when things start to change, then you're going to really understand what's going on. If you can get a good handle on what's going on right now, you'll be able to understand as things change how to engage in the markets on those changes. And changes happen very fast in this market. Here are the current negative dynamics that are going on in the market. 1 and 2 may be interchangeable. It's a chicken and egg thing, really. The stock market was extremely vulnerable. Those of you that followed me saw for months I was talking about the incredibly high valuations that are in the market, which makes it very sensitive to shocks. And shocks we certainly had. Rising interest rates, trade uncertainty over the tariffs reduced investor confidence in future corporate earnings, as all of this discussion about the coming likely recession will hit on margins, hit on earnings. All of those are causing a reset or repricing in the stock market. When the market was at 207% of GDP, it was probably overpriced by 1/3. Now it's given up a lot of that ground, but what is it down? 10, a 12% or 13% now from the high? It is still very overpriced. So upside progress may be a problem. All of that led investors to be selling equities, leading to downward pressure, a lot of volatility. Trade policies and tariffs. Again, chicken egg thing. Is it that the stock market was too high and vulnerable? Or is it the trade policy knocked down what was a bubble, essentially waiting to find a pin, as somebody else told me just recently on the internet? Love that. Bubble waiting to find a pin. President Trump imposed these tariffs on multiple countries and disrupts global trade. Tariffs increase the cost of imports. They fuel inflation, eventually bringing deflation, in my opinion, and that pressures the U.S. Global trade uncertainty reduces the confidence in the U.S. dollar. That leads to a decline in the dollar. And we saw the dollar moving down before any of this tariff stuff really was coming out. Market-driven rise in interest rates. Inflation concern had the interest rates going up. We saw the Fed cut rates and interest rates went up a whole percent. So we know that that was happening already. And that brings fiscal uncertainty, causes investors to demand higher yields for treasury bonds. And that's what we saw happen. The market pushed long-term yields higher, even though the Fed is not raising rates in its policy. I would think if the dollar keeps collapsing, the Fed will have to defend it, and that means higher rates, not lower rates. Higher yields increase borrowing costs for businesses and consumers. That slows economic growth, and that puts pressure on the markets. Here's what we looked at earlier. The yen is soaring, and the reverse carry trade is getting unwound. The yen strengthens as it serves as a safe haven currency during global instability. So as the yen is going up, as I showed you in the future analysis, then of course the dollar is going down. Investors who borrowed yen at low interest rates to invest in higher yielding assets, that's the carry trade, are forced to unwind these positions as the volatility rises. So that puts the pressure on global asset prices, especially US stocks and bonds. We saw that happen last year where the reverse carry trade put a lot of pressure on the market. And that is what's going on now, in addition to everything else that we see. Now the basis trade is collapsing. What does that mean? Hedge funds engaged in the basis trade. They arbitrage between the treasury bonds, cash, and the futures. And when they face widening spreads, it's due to market stress. So treasury yields and increased volatility make these highly leveraged trades unprofitable. There's about $800 billion in those trades out there. So essentially what happens is that it causes liquidity stress. I'll get to that in a moment. Margin calls force the hedge funds to liquidate positions, flooding the market with treasuries and futures. Essentially, what they do is they borrow from the repo market. They use that money to buy the cash treasuries, and then they short the futures because as you move towards the expiration time, that spread comes in. But when you get into this condition right now, then essentially what they do is they're getting forced to liquidate, and they are flooding the market. The liquidation of the basis trade reduces liquidity in treasury market, critical for global financial stability. Broker-dealers already have problems with regulatory capital requirements, are struggling to absorb all of this selling. Liquidity stress spreads across the markets, amplifying volatility and creating systematic risk. In other words, all of this selling in the bonds, all of this selling that's going on in the dollar because of the reverse carry trade, all of this exiting out of US denominated assets is causing a huge amount of stress. There's a feedback loop because falling asset prices, stocks and bonds, they erode investor confidence and the collateral for the leverage trades. This triggers more selling, more margin calls, more unwinding of positions across the markets, more of this reverse yen carry trade, and the cycle continues. A self-reinforcing negative feedback loop of instability. That's what's been going on right now, and that's why the markets have been getting hit. To stop this, you have to put confidence back in the markets. That's going to take a lot to happen and a long period of time. That's why I think that there's certain patterns in the market that are suggesting that we might be in a wide range in the markets coming up, and I'm going to show you that as we move forward. I hope that was really incredibly clear to you so you understand this dynamic that has been going on in the market right now. Okay, stock market analysis. We're going to look at these charts that have been causing this big trouble. And then we're going to look at the S&P 500, the NASDAQ, the VIX, and the Dow Jones Transports, which I think is important. And of course, our proprietary indicators and the market condition monitor. So let's start out by looking at the TLT and the dollar, which have been causing the big trouble. And I want you to see why this is not going to end soon and why that will prevent the stock market from having any kind of a big upside move that can hold. So let's take a look now as we look at, I'm going to switch this over from the yen over to TLT right here. So here is the TLT, and I'm going to put TLT up right here. And you can see that on the what's going on right now. And we'll go to the short-term trade here. And you see the short-term trade on TLT is bearish. I'll expand this right over here. We're going to maximize this sell. And I want you to see the cyclical patterns that are in here right now. And so this is your big dominant cycle there, and you can see the minor third. So here's your minor third trough right here, your minor third trough here, and where both the dominant and minor had your trough here. Here's your trough here. This one was a little hard to see right there as it had this left-hand translation. Once it broke under here, it was negative. And here's your trough here. What is this showing me right now? And this shows me that this big downside move in TLT, which tested this low over here, says at a very best case, if it tries to rally back up over here, it will likely continue on the downside into this period mid-June to out here potentially into August. This is a very bad sign if you get, underneath this low, which essentially you did, but it might be false because it didn't hold under there. It's going to say that the bond market's in trouble all the way out into 2026, as you can see right over here. Let's see how this trades in here. But this is warning to me that interest rates are very likely to be stubborn. In other words, they won't come down very much. They'll come down some when the bond market pops to the upside, but they basically will not come down very much. And over here, where TLT is pointing to the downside, it says to me you're likely to continue to get this pressure and the dynamic going on that I'm showing you right now for a while here out into the summer. When I look at the daily chart here in the TLT, this is very significant. Now, again, look at the gorgeous rhythms in here in the cycle analysis. We just showed you how to subscribe to our cycle analysis workshop so that you really understand this. When you break underneath this cycle low, see this cycle bullishly configured right in here, it says that you're likely to have a rally above that level. Look what happened right there. Then, as it after that failed and came down and broke this cycle low, which we have always listed right over there, it tells you things are negative. When I look at the timing on here, this comes out to around end of May, beginning of June. So there may even be another negative cycle out there, but that tells you as you've broken these weekly supports right over here, that even if you get some rallies, you're likely to fail and then get interest rates moving up again. This is not a good picture for interest rates. So the next part of this dynamic that I've been discussing with you, and by the way, you see the downturn here in momentum on the weekly TLT. When that happens, you usually fall for some significant number of weeks, as you see right over here, as you see that fail right there, and it's likely to keep putting pressure there. So the other part of this, collapse that's going on is in the dollar. And look at the timing on these cycle rhythms also. Here's your low right over here. Here's your attempted rally and translating negatively, saying that this decline is likely to go out into June, July. That's exactly what I just showed you in the interest rate picture. So that telling you that this dynamic that we have going on in markets right now is likely to continue, and that you're going to get rallies, you're going to get relief rallies, you're going to get tone changes like that we had last Wednesday with a 480 point move to the upside in the S&P 500. Those days are going to come, but the markets are going to keep failing again based on everything that I see in here. And I'm going to show you what I think that pattern is going to look like and why in just a few minutes. So that's the look at the TLT and the DXY as interest rates, the bond market, the dollar market are causing big trouble. And I don't think that's going to go away for a while, as I just showed you. So let's move over to the charts in the S&P 500. Let's look at SPX here. We'll put it up on SPY right over here. And you can see in here that based on the short term, because the short term turned up, the market has neutralized right now, and it was very negative, remember. So on 4-9, the short term pattern turned to neutral. That is an improvement. The intermediate pattern still bearish. When you get bearish dominance of the intermediate pattern and the less dominant short term pattern is neutral, it gives you a sense that rallies will fail and you're going to probably get rallies. Let's blow this up right over here for you to see, and you can see these cycle rhythms here. Now, this low over here, as you can see, absolutely bullseye tags that monthly support. That's the 38.2% support level right over there, and then has this big upside move. Here's your resistance areas, and it's come up to the lowest resistance area right now. 53.35, 54.90. 54.90 is very possible in this upside move. And here's another one up here at 56.45. I have some doubts about that one, but it still could make it up there. Now, the question is, what happens on the next move down in here? Now, I want you to keep your picture on this, because this is a crash. I'm going to show you other crashes and what the formations were after those crashes. And it's very important to your investing and trading to understand this. Is this market going to come down and test this low or break the low? Or are we going to actually get a range somewhere between, 55, 5,600 and somewhere down over here, 4,900 or so, where it keeps chopping around in here? I think that's more likely what's going to happen. And I'll show you why in just a few moments. Take a look here, and you could see this is the dominant cycle as measured by the MDY. The mid-cap stocks have really helped us with this. And you see this is a 21-day cycle. This is a 21-day cycle. This is a 20-day cycle. This one's short, 17 to 19 days. Now, this is somewhat common in crash-like environments where it gets so oversold it can't stay down for the full length of the whole cycle pattern. See over here, our option bias indicator. Whenever that you get those orange dots, it's warning you of an extreme situation, and that was perfect, as you got that right there. And now we're moving to the upside. The question is, and you can see in here at the dominant cycle right over here, that points out to sometime in mid-May. I'm going back to the weekly cycle. This comes over here sometime in mid-May. So this is the time frame we're looking at. That could be another downside move. Again, this is about 56.50 right over here. This we call this the repair level, 55.77. This is the 50% level at 5,500. This is the area that you really could get a chop in. And over here, coming out to mid-May, another move to the downside, which either doesn't get quite as low as this or takes it out by a little bit. When we got this big downside break over here, I said to my members in my most notables, I could see in these stocks, which I'm an observer of the heavyweights and the ones that affect the indexes, they didn't want to go down anymore. I mean, there was just buyers coming in. So what that did was it made me believe that a very oversold condition where these stocks fell so much, especially these mega caps, they were done going down. I mean, I could really see that. And now the situation is what will the test look like over here coming out into that time frame? When I move over to the NASDAQ NDX, we'll see right in here, that's really the same pattern. It got down here. This is the minor third. And the same thing. I mean, these stocks were very oversold. You see the bottom warning here, which said you were going to get a bounce. Resistance is up here. We'll just call it 19.4 up here to just over 20,000. We could see these prices. And then again, this comes out into this mid-May period right there on that daily chart. So this comes to the mid-May period here. Are we going to test this, take it out, come down and not get that far down, and then move up again? I'm gonna make a bold statement right now with all these negatives that are going on and everything I showed you. I said at the beginning of the year, I thought the market would decline into the May-June timeframe. That came to fruition, And now I'm going to tell you that I think that basically in here, outside of a test, I think the lows for the year have been seen. Now, there's a possibility we get a good rally out over here, which takes you out into July, August, September, and then the fourth quarter is bad. I that could take out these levels for sure, going out that far, because I believe this is the beginning of a bear market. Looking at this, the beginning of a secular bear market, and that bear market, the cyclical bear market, goes into 26. The secular bear market may go out a decade. So, I think that this is a big reset, and the chances of getting above that 61.47 high. By the way, 61.75 was where I thought the high would be for the year. The chances are just very small of that, and much more a possibility for range trading. Let's take a look at the VIX right over here. Now, the VIX daily chart, you can see this chart right over here points to a pullback in the VIX, which points to a rally in the stock market or a bounce out into sometime late April. So we're now coming into mid-April, a couple weeks that we could see a lot of sideways churn before you get over here and that next period into that mid-May period that I'm talking about, where the stock market begins to move down again for that test. So this is following that pattern nicely. Here's the weekly pattern, and here's where that index rebound is out into this mid-April period before we get into that May-June next period of risk. So all of that is in alignment with what I'm talking about. Let's look at one more chart, the Dow Jones Transportation Average. And this is just fantastic because I showed you this chart weeks and weeks and weeks ago. The green circles are where you begin the rising phases. The yellow ovals are where the declining phases are, or the periods of risk. When you had this rally and it came down and the momentum turned negative, it came down right exactly to the cycle trough. You could see that there. Then it rallied and failed, and then broke that level. It was in big trouble at that point. And this points out to July. So this whole choppy period that I'm talking about, I think potentially comes out into that May, June, and maybe even extend out a little later based on what I'm seeing in here on the Dow Jones Transports before you really start to move to the upside. Look at how gorgeous these rhythms are in these cycles. The troughs absolutely are nailing the time frame. And when you have a positive translation, you're probably going to make a new high. Positive translation, probably going to make a new high. Here's a positive translation that failed, but still made that positive translation, went to a new high. And then you broke this and it says you're going to go to lower lows. And that's exactly right. Please subscribe. Make that investment in our cycle analysis workshop so you do understand this. Some people are going to say, Slim, you promote too much in this show. It's not promoting, it's you learning. That's really what I want to happen as you look at that. So we have now looked at all of the charts I'm going to look at, but don't go away because I want you to see something. This is incredible. So I just made a case that the market was likely going to have a range trade coming up here. And I want you to see where that comes from. Now, the market has had big drops in these last few years and V bottoms. And you could say that last Wednesday looked like a V bottom. I don't think it was because of the timing that I just showed you. But I want you to see something that's really important. So I hope I hope that you're still here with me because this has been a long segment. And look at this. This is the crash of 29. Now you can see what happened there in the crash of 29. It had a giant decline. And of course, the decline that we have now is smaller than this. And eventually the 29 went down much, much further into 1933. But all we're looking for is the shape of what happens here for your trading. Look over here. Yes, we have our key indicators telling you when there was going to be a downside momentum resumptions in here. That was spot on. It shows you where the slim ribbon turned negative. All of our indicators work as far back as you go, and they really give you a good sense. The key is that it then begins to rally and comes down. Some of these are going to have deeper tests that I'm going to show you, but you can see they make a range in here after these big steep downside moves. Why? Because the stocks look cheap and because people want to invest after that. But the downside conditions and those things that cause the decline still are there. So you create a range. This is the crash of 46. The same thing. You can see in here where you got a very, very big decline or bear market. But then after it was over with, and look at the slim ribbon telling you about those negative conditions, it started to move sideways in here for over 2 months. And that's what happens. You build a range after big declines. So those of you that are looking for big upside moves out of here, the market is still fighting all of this negatives that are out there. And yes, things look cheap. Yes, you're going to get bounces, but you're also going to get downside moves. That's the crash of 46. Look at the 1960 bear market. It's right there in front of you. The same thing, a big downside move and then a range. It tries to rally, it comes back, it tests the low in this case, which is what I told you could very well happen as we come out into this May-June period. Here's the first leg of the bear market in 1973. The big downside move and then the big range in here that lasted for about 2.5 months. Tests the low. Here's the second leg of the bear market in 75. The big downside move. I'm starting to sing the song about this. And then the sideways correction and range that just comes down and tests the low. How about the crash of 78? By the way, this was one of my, oops, I didn't change that. That says bear of 75, but that's the crash of 70. Oh, that's the wrong, I have the wrong chart up there. So I'm going to skip past that one. Forget it. The crash of 87. This is it again. And you can see right there that big decline. Of course, the crash of 87 was steeper and than we have right now, but it's the same thing. You get that big counter upside move, momentum still stays negative. It says to you, yeah, you're going to trade in a range over here, and then it comes down and tests that low. So it's every one of those was the same thing, as you can see in there, and that's what I think is going on now. So you can see the kind of research that I did in here for you to understand this and why I think that, based on the analysis I just showed you, that the market is very likely to have seen the worst of it for this year. Yeah, it could tickle it out by a few percent on the downside in that May-June period. But, you know, we looked for the lows for the year to come in this time frame, and I actually think that is what's going to happen. If something gets absolutely crazy, then yes, you could have more free fall into that May-June period. But I think the highest probability is you're going to get into this kind of range that we're talking about. That's what I wanted to show you in the stock market. Man, did I give you a lot of information. It took me about 6 hours to put that together for you all. I want to remind you our cycle analysis workshop special is available now. For people that are brand new to us, it's $897. It's a $400 discount. It's my life's work teaching technical analysis and cycle analysis. So many videos in here. It's one of the greatest opportunities for you to learn technical analysis as I teach it. Level 3 and 4 members, write to Matt at askSlim.com for the exclusive discount link. It's only $797 to you. You're going to get an extra $100 discount. If anybody wants to jump in and become a level 3 or 4 member or upgrade, then do that and let Matt know you did that so we can give you this extra $100 discount. So